Hi guys, sorry from my side. Like, I think some errors were there because I was not able to share my screen. So, yeah, now I think it's all fine. You guys can see the screen. So, uh, basically, this today's session is regarding about repricing the economy in Bitcoin. It's a study done by Unchained and Strive. So it's a pretty old study. Like this report was published, I think, back in 2025. So, but like we did not get a chance to like go in and like check out the whole report. So, uh, basically, the today's point is like how to see the economy in Bitcoin or how to value things in Bitcoin. That is the main concept. Before I go into like in depth, so I hope like you guys have uh, watched our session on the risks related to investing in different securities because this session is around how to value things in Bitcoin, where you look into Bitcoin as unit of account. So, to the people who are not aware, basically, when uh, like key characteristics of money are basically it should be store of value, it should be unit of account, and it should be a medium of exchange. So, in case of Bitcoin, store of value proposition is much like better than the like uh, medium of exchange also we can say, but unit of account is not yet arrived. So it will happen in hyper Bitcoinized world. So this study is like explaining how can we value stocks or how can we value equities in terms of Bitcoin. And they have used a framework which is suitable to value equities in current world. So as we all know, currently we are not in a hyper Bitcoinized future. So there are some things which uh, needs to be valued in fiat world, and then like we discount it via using Bitcoin's rate of return or Bitcoin's CAGR, and then like look at it. Is it overvalued? Is it undervalued? So in this report or in this study, they have done an analysis on Apple. So they have built some scenarios like bullish, bearish, and some other scenarios. So in that scenarios, they have talked about like let me just like start from the beginning. So in the executive summary, as you can see, I'm not able to draw here because I'm sharing my laptop screen. But okay, so this as you can see this paper presents a paradigm shifting approach to asset valuation by proposing that instead of asking Bitcoin is worth in dollars, investors should ask what all other assets are worth in Bitcoin terms. So this is basically the whole crux of the today's session and this whole report. Then they have used the discounted cash flow model to like analyze Apple, and they have like talked about cost of capital, Bitcoin's expected return, and one interesting thing that they have done is basically equity stability premium. So in this model, they have used Bitcoin CAGR as I was talking about. Because we are using Bitcoin CAGR, uh, because of that, uh, basically, um, like as we are using Bitcoin CAGR, equity stability premium. So as we all know, Bitcoin is based on dollars. Like when we see Bitcoin in terms of dollars, it's volatile. So but these equities are traded in dollars. So that volatility which we see in Bitcoin, if we value Apple in dollar terms and Bitcoin in dollar terms, so that volatility of Apple in dollar terms is like uh, it gets cut. But when you try and value things in terms of Bitcoin, that volatility needs to be like somewhat figured out. So to do that, uh, in this report, they have like given equities some stability premium. Uh, like when I invest in Apple, because Apple is not as volatile as Bitcoin, I'm giving this equity some stability premium. So this is something that we need to consider. So here also they have written lower volatility compared to Bitcoin. So depending on these assumptions, Apple's valuation in Bitcoin terms ranges from significantly overvalued to modestly undervalued. So in the further part, there are like some other like they have made three cases: bearish, like normal case, and bullish case. So these three cases have been like talked about. Then in the introduction part, they have talked about the what are the ways through which we can like predict the price of Bitcoin in the longer term. So there are various models like S2F, Power Law, Bitcoin 24, and whatnot. But uh, as we like as the time passes, we see that most models are like getting broken. So S2F was very good in the early phase of Bitcoin, but now essentially many people have built in consensus that power law is much more like accurate model, but we don't know like what might happen in the future. So even if you take the power law assumption and use that assumption in whole of the calculation, that is good enough. Then, before we dive deep into Bitcoin, I think you all understand this very like uh, like we have a good understanding of this because we are Bitcoiners. But still, let me skim through this. So the current reality is basically why are we investing $1 or why are we investing $100 today, because we want something in return so that we can beat inflation and generate some return for ourselves. But what is happening, even if I have invested $1 and I turn that $1 into $1.1 in 12 months? So, like, there are various ways to achieve this. People are diversifying portfolios with stocks, bonds, and real estate. So if we see that S&P 500 8.6 CAGR since 1971, housing prices have 5.3% CAGR since 1971. But when you compare this with M2, I think here you can see this chart. So nominal CAGR, this is basically nominal, like we do not account it for M2 inflation, but this adjusted monetary, like adjusting for M2 money supply, we can see the real returns. So uh, average M2 growth rate in the US is around 8 to 9%. So I think they have subtracted around 8 point something percent to come at this 1.3 number. So when you see adjusted returns after accounting M2 money supply, you see that S&P is giving 1.3% and house prices are essentially negative. What does this mean? The value which you have earned via your labor or via your like work, that value, if you invest in houses, is getting destroyed by 1% every year since 1971. And if you have invested that value in S&P 500, you have got like 1.3% real compounding. Then this is what happens in like the current reality. This is current reality of the world. Then let me come to now this chart, like we all have seen this chart like again and again many times. So Bitcoin is highly scarce, highly fungible, highly portable, highly durable, and highly divisible. So these all qualities makes Bitcoin a better form of money. Then how do you value money? So, like the three things which I talked in the starting, like basically store of value, medium of exchange, and unit of account. So these three things are key pillars. Or some people also say that money evolves through these three phases. Like first, it is into store of value phase, then it goes into medium of exchange phase, and then when we have hyper Bitcoin's future, we see basically the unit of account phase. So today we are trying to focus more on the unit of account thing in Bitcoin and try to value different equities in uh, basically Bitcoin terms. So this research is also based on Mimesis Capital. They did this before this study. So they took some work from Mimesis Capital and they carried forward their own work as well. So before we go into Bitcoin valuation, I want you guys to understand how the US dollar valuation of Apple looks like. So uh, when I am valuing an equity, then I have some like so basically in the traditional financial world, US treasuries are basically risk-free rate of return. Like it is said that it is risk-free, but as we all know, it's not risk-free always, or it is not really risk-free. But for now, I think it's fair enough to assume it is risk-free just for our calculations, because all the TradFi models are based on the government treasuries are risk-free because government has the power to print and they have power to tax their own people. So because of this powers, um, like the world considers uh, the government treasury bonds as risk-free rate of return. So this all of this report is based was written on somewhere around 2025. So this 3.9% should be some like at that point in time, federal fund rate should have been closer to this. That's why we are seeing 3.9%. But I think right now it should be somewhere around 4. So, but yeah, keep in mind this is not like right now. This is not a latest data. This is based on 2025 scenario. So this is the thing. 10-year US Treasury bond deal was all at that time was 3.9%. Then when think of it as a perspective of equity investors. So let's say you have $100,000 to invest and you need to choose like where should I put my money. So bonds and equities. Bonds are giving you 3.9% risk free. And equities, when you invest in equities, as you are taking more risk because of what all reasons we discussed in the risks associated when you invest in equities session. So in that session, we talked about a whole lot of risks: management risk, execution risk, email risk, then political risk, regulator risk, and tax arbitrage risk and whatnot. So all these risks to like make our model or to justify our investment in that equity, we give a premium to that equity called as equity risk premium. And don't think it as a premium which we are giving in terms of valuation. This premium is basically uh, we are trying to discount it in the current future. And when we allot equity risk premium, we are essentially pulling it at much higher rate. So think it from an example like this. Let's say I am pulling $100 in 10 years at 5%. So the present value of $100 uh, when I take like required rate of return as 5% will be much more higher than if I take required rate of return as 10%. So this equity risk premium is essentially added to 3.9%. So 3.9 plus 5%, and then whatever, 5 plus 3.9. So we get risk. basically rate of required rate of return is essentially somewhere around 9%. So we discount future value of Apple to today by using 9% as our discount rate. So discounting at 9% will give somewhat lower value if I discount at 5%. Then coming to what is next talked about. So here they have talked about some cost of debt for Apple is 4.4%, the cost of equity. Now, in most of the cases, the cost of equity or the expected return for investors in this case in Apple stock is calculated as 8.9%. So cost of equity and required rate of return is always, in most cases is equal to like cost of equity is equal to required rate of return. So KE is equal to RE. So what is KE? KE is cost of equity and RE is like required rate of return. So combining these factors, we get a WACC. What is WACC? WACC is basically KC, weighted average cost of capital. KC is basically um, weighted average. When I say weighted average, how much amount of weight is in the capital structure of that particular company for debt and for equity. So if a company has higher um, like higher debt in the capital structure, then as we all know, for a company, um, basically the cost of debt is lower and cost of equity is higher. So, but even though cost of equity is higher, the amount of risk for the company when it raises funds, it is it is a decision for a CFO of that company. Like, what should we do? Should we raise via equity or should we raise via debt? So this depends on the health of the balance sheet. So if your debt to equity ratio of your company is less, um, there are industry standards. So for different industries, they have different standards for ideal debt to equity ratios. So if you have like less amount of debt in your balance sheet as compared to your peers in in the industry. So for example, let's say we are valuing TCS, and TCS is essentially zero debt company. When I say zero debt, net of cash, it's zero debt. So when I'm valuing TCS, I will check like how is the debt to equity ratios in the IT industry sector. So in general, IT businesses are like they try to not take debt, but if they like if their business is growing and they require cash, I think it's good for them to take some debt in so that we can leverage our balance sheet and like give some extra return to our shareholders. Because anyways, cost of debt will be lower for any company than cost of equity. Because equity investors demand higher rate of return to justify their investment, but the debt holders are getting like fixed payments, like they are getting fixed coupons on their investments. So they generally do not care like how the company will perform in the longer term. Like um, if the company outperforms every index that they are in, debt holders are like they do not get anything if company performs better. But if you are an equity investor, if company performs better than a benchmark, your investment is essentially like basically you have made a good decision when you have invested in such a equity. Now, so this is what working average cost of. So as I was explaining, working average cost of capital. So this is KC, cost of capital for the company. KC has come out to 8.7%. So how did they calculate this? So KC is basically WD into KD plus WE into KE. Now, what is WD and WE? So WD is basically weight of debt in balance sheet, and KD is cost of debt. So you multiply that, and then you basically weight of equity into cost of equity, and then you add up. So whatever number you get is basically the working average cost of capital for the company. Then now coming to Apple's valuation, which they have performed through uh, this traditional USD denominated valuation is they have taken 3.9% as 10-year risk-free rate. They have assumed 5% equity risk premium and cost of debt is 4.4, equity is 8.9. Total value of equity is this, like should be 3.3 trillion if I'm not wrong. 100,000, 100 million, 100 billion, yeah, 3.3 trillion, and debt is around 125 billion dollars. So, weighting average cost of capital comes to 8.7%. P multiple they have assumed is 20, and share outstanding is this. So now, what they have done? They have done a discounted cash flow analysis for the like basically Apple share. So how did they came up with this number? Is basically they have forecasted the earnings growth at a rate of 15.33%. Now, how they have come up with this number? Basically, they have looked at some historical average, like what is the historical number at which earnings are growing, and then they have basically modeled this earnings that they should keep continue to grow at this number. So they have forecasted future earnings in 2035 is $32, and they have kept the CAGR of earnings at 15% constant. Now, exit value when you see is $643, and when you discount this $643 currently to in this case of this model, when you discount this 643 to present value, it comes to $268. So uh, basically, the at that point in time in like uh, the current market price at in 2025 when this model was designed was $371. So implied market cap is it is basically essentially multiplying share price into the shares outstanding, and implied market cap is calculated like 5.6 trillion. Then according to the basically they have calculated this as the price should be around 230. So because of this, it says that increase needed to be fairly valued is 61%. I think I told you in reverse. So implied price when I talked about this $643, so according to the model, when you discount it at 8.7% to today, that is in 2025, implied price comes to $371. And this price, we have to like this is the value of Apple share according to our model via discounting $643 to today. And when you discount this to today, in this is essentially in 2025, you are getting $371. But at that point in time, the market price for the Apple was $230. So this model is suggesting that Apple should increase 61% to be fairly valued. Now, let us come now to what is happening in Bitcoin terms. How are we looking to value in Bitcoin terms? So in Bitcoin terms, as I was talking about, they have considered something to give equity as equity stability premium, because equities are in dollars, and because they are in dollars, they are like stable. But like as Bitcoin is volatile, to like to come at some midpoint and try to value these equities in Bitcoin, they have so there should be a way to like remove Bitcoin's volatility and value these investments. So to remove Bitcoin's volatility from from our valuation model, what they have done is basically they have given something to equity as equity stability premium. So more stable or the more stable the equity is, the less the less is their discount rate. So lesser the discount rate will get higher the uh, the number which needs to be the current market value or current stock price. But like as we all know, Bitcoin CAGR is also there. So Bitcoin CAGR, if we take at around 30% or 29%, that also needs to be figured out because the idea of investing in equity is like because I'm selling or I am I'm seeing Bitcoin as unit of account and I want to see like can I make more Bitcoins if I invest in this particular equity, or will I make less Bitcoins if I invest in this particular equity? So to do this, we have to take uh, this thing. So USD discount rate. Now you guys know what is USD discount rate. It's basically risk-free rate plus equity risk premium. What is Bitcoin discount rate? It's Bitcoin expected return minus equity stability premium. So in this method, where we are trying to value equities in terms of Bitcoin, we will be subtracting equity stability premium from Bitcoin's expected return. Bitcoin's expected return will depend on your own models or your own analysis, like how much are you looking to what's your assumed Bitcoin's rate of growth or what's your assumed Bitcoin CAGR, and depending on that it will depend like how are you looking to basically discount the or this will depend. So in this model, they have taken Bitcoin's expected return as 29%, which is also close to Bitcoin 24 model by strategy. Then let's go to the again here Apple's valuation in BTC terms. So Bitcoin expected return, this is 29%. Equity stability premium, they have assumed to minus 10%. Now, how they have come to minus 10%, they have not really talked about like how they have come, but essentially the idea that I have that they have maybe looked into is basically they might have seen the Apple's volatility to the US dollar and Bitcoin's volatility to the US dollar. So, for example, if Bitcoin's volatility is somewhere around 40, it's 40 asset, and Apple should be somewhere around, let's say, some X. So they should have subtracted this volatility and then calculated this number called as equity stability premium. So what does this equity stability premium do? It essentially hedges you from Bitcoin's volatility, and that's the reason why we are giving this equity stability premium. So in the first example, they have assumed equity stability premium as minus 10%. Now in here, they have taken cost of debt as 0% and cost of equity as 19%. Now how does this 19 come? Basically 29 minus 10. So that comes around to 19. And this is all equity. So I think to make them their life easier, they have assumed this all equity. They have not assumed any cost of debt or something. So in this case, the working average cost of capital is also 19%. And when you discount, so this is Bitcoin's price. Bitcoin's price in 2025 90K, 2026 116K, 27 149, and in 2035 it should be somewhere closer to a million via taking this Bitcoin's 29% CAGR. Then, how are Apple's earnings compounding? So basically, these earnings will keep continuing to compound at 15%, which were derived in the real valuations as well. So if I am looking to like value Apple in terms of basically Bitcoin, the earnings which a company can do will not change, but the denominator will change. What is denominator? Denominator is basically the discount rate that which we are looking to use. Here they have done something more interesting, like earnings in terms of sats. So if Bitcoin is increasing at 29% and your earnings are growing, let's say at 15%, so there is a difference which will lead to earning less number of sats. So if you have seen these charts, like let's say you are working in a company and in the longer term your salary will let you buy less and less number of sats going over time. So will be the similar case in terms of companies as well, because Bitcoin's number is defined. So it will be pretty hard for a company to like earn more sats. Like going forward for any company, I think earnings CAGR and BTC will be like in it will be a lower, it will continue to decrease, or it has to be like a pretty high growth company where you are growing by, let's say, 50% CAGR and your earnings are also increasing at 50% CAGR. So net earnings that you are able to accumulate is basically which will come out to somewhere around 20%. But finding these companies will be very like tough job, and but yeah, let's see. So here in case of Apple, they have like earnings CAGR will be minus. Then um, they have calculated exit value in terms of USD. What is exit value? Exit value is basically um, in 2035 exit value is 482. What is this? This 482 has come up by discounting the company into perpetuity. So if I discount a particular company in perpetuity, and what is the value in 2035? So that comes at around $482. And if you discount that $482 again to like present value, that is in 2025, it comes around 75. And these then we have to calculate from 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, and then add up this 25 to 34, and then add this $75 to these remaining present values of these remaining years. So which will come around to $143. So 143, and where according to the current price in 2025, it was trading around $230. So according to this model, the price of Apple stock when we are valuing in Bitcoin, it should go down by 38%. And if this goes down by 38%, this is the point where I think we should consider to invest in Apple, but this is not the case because these companies are valued in terms of USD. So eh, this is the thing. Now, the second model. First model was, I think, base case. So it was base model. The second model is conservative model. So what they have done in conservative model, they have increased equity stability premium from 10% to 20%. So now, when you are calculating discount rate, you have to subtract 29 minus 20, which will come around 9%. So when this happens in this ultra, or let's say conservative model, you have given a like Apple stock as a like uh, a good stability premium. I think here value will come higher than our previous. Okay. So here value has came around $300, and in the last model the value was around $143. So why did this happen? This happened because we have discounted future future earnings or future whatever CAGR of company's growth to today by 9%. And when you discount future earnings at 9%, it becomes like it is easier for you. Basically, the present value goes higher because this is inverse relation. Like whenever you try to calculate present value of any stock, that present value is inversely related to your discount rate. So when you discount it by lesser number, your present value will increase. And here you are discounted with 19% in this model. We are discounting at 9%. So 9% is less than 19. That's the reason why we have got 300 as the value. So this all depends on what, as you as an investor, are okay to give equity a stability premium. So higher the stability premium you are giving to any equity, higher will be the US dollar amount, and lower the stability premium which you will give to equities, um, the lower the value of present value of stock will come out. So if you are a person which like for example, you are not okay with Bitcoin's volatility and you are looking to value Apple in terms of Bitcoin because you think that Bitcoin is the ultimate money and you want to be conservative. Let's say, who is conservative investor? Conservative investor is basically some person like who has less risk appetite and who is let's say there is an average lifespan of a particular person in particular country. I think in India is somewhere around mid 70s. So if that person is in late 60s or in late 70s, I think he should mostly that person does not invest in equities, but let's say that guy has like very high amount of money, so he can take much more risk. How do you decide um, like the risk that I can take? So there are a couple of factors. Your own feeling that how much risk that should I take? This is the thing. How willing are you to take more risk? First one. Then what is your age? Then what is your income? What is your net worth? So these things are dependent on your risk. Like all these things depend on the level of risk that you can take. And if you are able to take higher risk, then give equity stability premium a lower amount. And if you are not able to take higher risk, or if you are someone who wants stability in your portfolio, I think this is the model, conservative model. So with this, you have given Apple a 20 minus, basically a 20% stability premium. And when you calculate rate of return for this model, it comes around 9%. And with 9%, the implied price comes around $300. And as we all know, the current price of Apple is $230. So increase needed to be fairly valued is 31%. What is 31%? Is basically the difference between 300 and 230. So increase in 31% of the stock will justify Apple's um, like current value. Now, the last model, that is bull model. In bull model, literally given 0% equity stability premium. So your cost of equity comes to um, 29%. And here, so here, because you have like this is bull model. What is bull model? Bull model essentially from a perspective of Bitcoin investor. So if you are a Bitcoin investor and you do not want any equity stability premium, so you will want to discount equities directly with Bitcoin CAGR. So Bitcoin CAGR is around 29% and you have discounted this uh, $482. with 29%, and with $482, the present value in 2035 comes to $31, and all the other present values which are in 25, 26, 27, 28 until 2034, they should be 7.73, 6.91, 6.18, and so on. So this should all add up to $80.37. And this leads to decline needed to be fairly valued is minus 65%, because the current value of Apple's dollar in USD is $230. So this is what a bull model looks like. What is the conclusion? So conclusion is basically Bitcoin is not just another asset. It is a better lens for viewing economic reality. Investors are beginning to reconsider fiat currencies, bonds, and other traditional assets are fundamentally less reliable long-term store of values. So, uh, how are you looking to value in terms of like Bitcoin? By reallocated to Bitcoin, they gain more stable foundation for long-term wealth. So, all these things are designed in basically what we covered as it is talked in this conclusion. Beyond that, this playbook is already in motion. Strategy Nasdaq MSTR pioneered it, demonstrating that companies can leverage the excess valuation of equities to acquire Bitcoin, an asset that offers superior long-term store of value characteristics. As Bitcoin adoption accelerates and more investors recognize its monetary superiority, corporations that fail to adopt Bitcoin-based treasury strategy risk falling behind those that do. So this paper says that a strategy which has done like all of its they have moved their balance sheet from dollars to BTC, and this transition will happen slowly and steadily. So as we all go into this transition, we'll see equities trade at a fair value and not like hyped values. So yeah, thanks Amol.